Hey everybody, and welcome to week number 8. Just as a point of review, we took the first test last Monday. Actually, the results were very, very good. Many of you did very well on it. I was happy to see that. For anybody who has any questions about it, don't hesitate to reach out to me. I would just say that the thing that what we did with the first test will be repeated somewhat the same in the second test, coming up now in a few weeks. And the good news is, if you didn't do as well as you wanted to, you have the opportunity to take the test at the end of the class, which covers chapters 16, 17, and 19. that test will be due on May 6th. That's an optional test. It's literally extra credit. So whatever you do with it, you will add those points to your total. So it helps make up for things that you didn't do so well on throughout the class. Okay, so let's talk about this coming week. The last week before spring break, which means we're coming up really close to midterm. After midterm, one of the things that I like to do with my students in these asynchronous classes is I'm going to set up similar to what we did with the one-on-one meetings. I'm going to set that up again, and we can kind of review where you're at from a grade standpoint, and talk about what to expect for the second half of class. So I will set that up, and when you guys get back, you'll have the opportunity to sign up for that. And we'll have the opportunity to speak one-on-one. Okay, so talking about this week is actually a very important week. We've got two chapters, chapters 10 and 11. They're very highly related, so that's why they're together. Let me get to the text. What you learned in chapter 9 is very foundational to chapters 10 and 11, so they build up. The chapters kind of build at this point on each other. So in chapter 10, we're going to talk about valuation and the rates of return. Your learning objectives here are to know the valuation of a financial asset is based on the present value of its future cash flows. That basic concept is a very important one, so try to understand that as well as you can. We're going to use variations on that quite a bit throughout the rest of the class. You're going to see that the required rate of return in valuing the asset is based on the risk involved. Required rate of return is an important concept in looking at longer-term financial analysis. So pay real close attention to what goes into that. It's kind of a fundamental or a linchpin sort of thing, if you will, for most of the formulas we're going to look at going forward. We're going to talk. You'll recall that bond valuation is based on the process of determining the present value of interest payments plus the present value of any principal payments at maturity. So it's a good exercise to see how we actually put some of these things into place. Ultimately, we're driving towards something where we're going to try to get a sense of what the cost of the capital is to the firm. That's sort of the overarching thing to take a look at. We'll explain the basics of doing preferred stock valuation, and we'll also talk about how common stock valuation is determined as well as sources of capital. So this is an interesting chapter. I'm going to flip forward here real quick. And what I really like this about the text, by the way, I think they do a really nice job with this, is when they're going to talk about all the particulars that go into the how you actually do the calculations, or what the calculations are based on. But then we're going to talk about how, it's actually shown how to do this on your financial calculator, which you're definitely going to put to use now. Your financial calculator comes in handy, or if you are somebody who's adept at Excel, they also give you a way to look at it in Excel, showing you the right types of formulas and how to set it up, these different calculations in Excel. So either way, they both work, but get familiar with one of the two methods. It'll be very, very helpful to doing the different problems in the homework. Okay, so let's take a jump forward to chapter 11. This is where we're actually looking at the cost of capital. And in here, you're going to want to recall that the cost of capital represents the weighted average of the cost of the source of financing to the firm. And you'll look at it from the perspective of, it kind of depends on the mix of capital sources you have. It's going to actually ultimately determine what the cost of capital is. Understand the cost of capital is normally the discount rate to use in analyzing an investment. Again, that discount rate is a linchpin, sort of a number that you're going to have to understand what drives it, because we will use it in various forms going forward. Recognize that the cost of capital is based on the valuation techniques from the previous chapter, things that we've done, and we're going to apply to bonds, preferred stock, and common stock. So again, you're going to see some commonality in the actual calculations that we're doing, but just a little bit of a twist in terms of what it's being used for. Explain how a firm attempts to find the minimum cost of capital through varying the mix of its sources of finance. That kind of makes sense, but you'll see the different ways to actually accomplish that. And recall that the cost of capital may eventually increase as larger amounts of financing are utilized, not surprisingly. So all the basics that you've been learning about we're kind of starting to put it to use in what we're doing in chapters 10 and 11. So give it your best shot. I wish you the best of luck. And if you have any questions about it, don't hesitate to reach out to me. And I won't talk to you next week, but I hope you have a good spring break. So again, if you have any questions, certainly let me know. Thank you.